We are here at Investor Insights with Eric Green, who is the Chief Investment Officer, Equity and Senior Managing Partner of Penn Capital. And Eric, thank you for taking your time today.
You're welcome. Happy to do this. Thank you.
Eric, you've been a successful investor in the gaming space for some time through Penn Capital. Tell us a little bit about yourself and about Penn Capital.
Sure. First, I want to express similar thoughts that Jason expressed last week on Jason Ader on his call. I've had a long relationship with Frank for probably 15 to 20 years at this point. His newsletter is absolutely a must read for anybody in the gaming industry. And I want to thank him for allowing me to speak at this, but he's been invaluable for me in my gaming research over the years. Penn Capital we manage $3 billion in total assets, high yield fixed income, bank loans, converts, and equities. Each one of our strategies are distinct. So we have high yield strategies, a bank loan strategies, a small to mid cap strategy. Each one of our analysts cover the entire capital structure of the companies we follow. And I've always covered gaming. I've been at Penn for 24 years. When I look at a gaming company, I look at not only the bonds, the stock, the converts, the bank loans, the preferreds, every piece of that capital structure. And what I find interesting or attractive, we put in our different strategies. We look for capital structure catalysts, things that can go right, the capital structure that will be good for the equity, good for the bonds, or good for other pieces of the capital structure. At some point, we could own every piece of the capital structure. I remember a few years back, we owned MGM bonds, their convert, their bank debt, as well as their equity at the same time. We talk to management teams constantly and have had large exposures in the gaming sector most of my career. I think I've had a position either in the credit or equity of most gaming companies.
Okay, great. Eric, before we get into talking specific names, let's talk a little bit about the market overall. We've got some very high valuations. We also have, I believe, a topic that you will be addressing, which is sustainability of margins, which maybe justify some of these valuations. Give us your take on that.
I think first stepping back to the overall market, we have some areas of significant excess. Clearly, the most obvious would be the GameStops of the world, but you also see it in the alternative energy space, electric vehicles. You see it in the marijuana stocks. You see it in Bitcoin, and you do see it in some of the online gaming stocks where margins the multiples are really not sustainable at these levels for long periods of time. I'd also argue that growth stocks in general are very expensive when you see these software companies trading at 10, 15, 20 times revenues. That's been a function of lower rates, interest rates, because you're discounting future cash flows at zero. Now, as rates start to move higher, we think some of those multiples will come down. Some of that speculation will get crushed. We like value stocks, and that's a little bit talking my own book because we like value stocks. But this does remind me of during the dot-com bubble back in the year 2000. And that's when growth stocks and value stocks traded this huge valuation discrepancy. And once that bubble burst, value went on to beat growth for the next 10 years. I think we very likely we're in that period again. Value stocks can outperform, and that's generally good for the traditional bricks and mortar gaming company that we like to buy.
You had mentioned, we had mentioned margins, because margins have improved dramatically during this past year as the casino operators have cut expenses in the light of various kinds of travel and capacity restrictions. How do you see that playing out as we return to a more normal, we hope, business environment?
Sure. I think that the 1,100 to 1,500 basis point margin expansions on 25% less revenue is clearly not sustainable. And I don't think there's anybody in the industry that believes that. There are a lot of factors that went into it. Some of this took place when we were getting stimulus checks. We got very new customer base, which potentially some of those people will stay. The younger customer, the older customers should come back. But some of the promotions that went on in the past will come back, but I think to a much lesser extent than the market's anticipating. Certainly when I look out at sell side estimates in the future, I see that very few are giving credit for sustainable margin expansion. The industry has evolved over the last 20 years that I've been covering it. There's more consolidation and new leaders in the business like Tom Reeg at Caesars, Jay over at Penn National. They think differently. They're not out there to promote as much as possible. They don't create uncompetitive type environments, and they're very serious about cutting back on the buffets, cutting back on some of the real low margin promotional activity that went on. They're more interested in free play rather than giving away things that are very costly, like restaurant food at the restaurants, buffets, and things like that. In terms of hiring, I think COVID has taught a lot of people lessons, a lot of the companies lessons, not just in gaming, but all discretionary, is how many people you actually need to be working at a facility, and can you rationalize that? But I see it, I should have mentioned earlier, I'm a board member at Full House Resorts, been a board member since July. Very interesting to see the things that they've been doing over there. But I believe very strongly, like most of the management teams I talk to, that at least 500 basis points of margin expansion is possible going forward. And if we get to revenue levels back that we had in 2019, which I also believe is very possible, the earnings are way too low that are out there, which means a lot of these regional stocks are much cheaper than they appear on what the consensus numbers are right now. So we think that there are values out there in this market, and the margin improvement story is misunderstood. And I believe that more of it is sustainable than what's priced into the market.
One of the things that has everybody excited is the proliferation of online sports betting and online gaming in the United States. And we've seen estimates that, as you've seen, that have run to 25, 35 billion, some even as high as 50 billion for online and sports betting combined. How do you see this phenomenon playing out? And is Penn Capital, does it have any favorite names in that space?
Sure. So I've seen all types of estimates, and they get revised monthly, and what the total addressable market is. I don't think anybody knows. This is like the very early days of any growth business, that it looks like it's going to be huge, but nobody knows the exact numbers. Estimates are all over the place, whether you're looking at electric vehicles, how many they're going to be in 20 years, similar to that. We just know it's going to grow, and it's going to grow very fast. And my investment time horizon is about 3 to 5 years when I'm looking out on the portfolio and our names. And for the next 3 to 5 years, it's going straight up. The amount of illegal, let's start with sports betting, the amount of illegal sports betting that goes on is in the billions. And the states who are suffering in many cases, many states, they want a share of that. They want to share the tax revenue of that sports betting. That's not going away. People are going to bet on sports, whether it's legal or illegal. And making it legal is going to be a big opportunity. And we're going to see every day, I would say, going forward, you're going to see more sports betting than you did the day before, at least on a year-over-year basis and a comparable sports basis. So it's a very, very strong growth for the next several years. I don't know what that market is, but you want every company should have some ability to offer a sports betting product or an online betting product, whether they're using through joint ventures and relationships with a FanDuel, or using a technology provider like like GAN or somebody like that. Every company needs to have a solution, because there's not a reason to lose your customer base, your database, to somebody else. That customer may have a desire to gamble online, sports or online casino, and you don't want to lose that. So you want to keep your database customer, and you want to find a way to get them. Most companies don't have the financial wherewithal or the technology insights to do this on their own. So they will use people. We are an investor in GAN when it came public in the United States. We're still an investor there. It's not going to be all things to all people. Some of the big casino companies will have their own solutions, but the smaller ones are going to need good, solid technology providers like GAN. And it's really them in Scientific Games that provides a lot of that technology that could be outsourced. And we like the management team. We like what they're doing there. I think that over the next few years, you're going to get a bump because of sports betting, because of online casino in gross gaming revenues by a couple hundred basis points at least each year going forward for the next several years. As some casinos will benefit just from having a sports book and bringing in that newer customer that is not just going to be at the sports book, but will play some hands of blackjack, will spend more money within the casino. It is, I think Tom Reeg said it a while back, that it's the biggest growth opportunity that the sector has seen since riverboat gaming took off. Sports betting and online casino are huge opportunities, in many ways to play it. And our little companies farmed out our licensed out our sports betting licenses in Indiana and Colorado, where we get paid a minimum fee and then a revenue share above that. There's several ways to take advantage of it, but this is a big deal for the industry and generally very positive for the industry. A lot of winners.
GAN is an interesting story. They've got the entrepreneurial CEO who's so enthusiastic in Dermot Smurfett. It's a small company. Do they run the risk of being out R&D'd, if that's a word, by bigger competitors like Scientific Games and IGT? Can be.
I think they're ahead of the game. They've been doing it for years and years and years in Europe. They've gained a lot of customers with longer term contracts. Over a long period of time, I think that GAN probably gets bought by one of those guys who wants, or one of the big casino companies that want their own internal technology solution. But sure, there's a risk over the long term. In the short run, they're gathering more business. They've made a few acquisitions that seem timely and give them some opportunities. But yes, there's a lot of R&D that needs to go into this, and there's a possibility that the big companies are able to spend more and come up with a better solution.
Eric, this is Investor Insights. Give us some insights as to 2 or 3 of your best ideas.
Sure. We're looking for companies that aren't as well understood as we think they should be, looking for value opportunities, companies that generate free cash flow, companies that aren't necessarily covered by 30 or 40 sell-side analysts. So one of my first idea that I really like is Golden Gaming, or Golden Entertainment, sorry. Well-run company, used to be just a route operator. Now they've transformed that business into a solid Nevada locals business, along with a great property in Maryland and a strip property where they've renovated the Strat. The stock is very inexpensive relative to the group. It's a $20 stock that could easily generate $4 in free cash flow in 2022 if they can maintain a portion of their margin gains. So if they maintain 500 of the 1,000 to 1,500 basis point gains that they've seen at different properties, this is a company that could do $50 million more than analyst estimates, could do $4 in free cash flow on a $20 stock. Another very savvy move by management, they negotiated with William Hill that if William Hill was ever acquired, that they would get a fee from William Hill. With the Caesars acquisition taking place, they could get up to $80 million in cash as negotiated in that agreement. That's worth almost $4 a share to the stock, to a $20 stock. So it's not well covered, not many analysts covered on the street. It's not a real liquid stock, and it appears to have more leverage than some of the other ones. But with the free cash flow that they're going to generate with their existing properties, with the up to $80 million in cash, it'll delever very, very quickly. We like that name.
Okay, and another.
Bally. Bally is the old Twin Rivers that they transformed the company, changed the name about a couple months ago with their acquisition of Bally in Atlantic City. Got the Bally brand name, which means a lot to some people, maybe not to the younger crowd, but it will. Bally did a deal with Sinclair with their regional sports networks. Sinclair has 21 regional sports networks, which show baseball games, local or regional baseball, basketball, hockey, and local sports games. They will be there. They used to be. They bought that. Sinclair bought it from Fox in the Disney transaction. They're going to be renamed the Bally Sports Network. Sinclair is going to take up to a 30% equity stake in Bally on this deal, and Bally is going to be featured for sports betting throughout these regional sports networks as the states approve sports betting and ultimately gain access through online gaming. Sinclair also has about 150 television stations throughout the country. And with this deal, Sinclair is really, and with their ownership stake, incentivized to push Bally and for this deal to be good for both of them from an advertising standpoint for Sinclair, from an equity appreciation standpoint for Sinclair, and then Bally to exploit this opportunity. One day you're going to be watching a baseball game and the batter is going to be come up and in the lower right-hand corner, it's going to say something like, this batter struck out the last 2 times he was up, bet 15-1 that he'll strike out this time he's up. And you may be able to click your remote control or go on your Bally app, but that's all Bally. They get credit for that. And you just put on your remote control that you want to put $50 on it, goes right to your account, and they benefit from that. And then you become an online casino customer. It's a really big opportunity with a great demographic, a sports watching demographic. They also acquired the technology through BetWorks. They will soon have 14 properties in 11 states. When this deal, and Bally itself trades at the low end multiple on its bricks and mortar EBITDA versus the rest of the group. So it trades around 8.5, 9 times its 2022 estimated bricks and mortar EBITDA. And so that's kind of a fair valuation, but you're paying absolutely nothing or very little for that sports betting opportunity. And to give you a sense, with Penn National, which has done everything right with Barstool, done a great job with it. Penn is historically traded because they just they don't own their assets, or they're just an operator. They've traded between 6 and 7 times. Today they trade at 13 times, and many estimates out there would suggest that Penn's market cap, as the stock has gone from 5 to 120, is up about $15 billion just because of their Barstool deal and that sports betting online casino opportunity. Barstool is only in Pennsylvania and recently in Michigan, so you haven't even seen the opportunity there. So Penn is getting a lot of credit, and probably a lot of it deserved, in their stock price and in their multiple for this opportunity. The demographic of the people watching the Bally Sports Network and watching the Fox games on Sinclair stations that will see the Bally advertising, that's a great demographic. Sinclair covers, between their television stations and their RSNs, they cover about 85% of the adult population. With their technology, with their market access in the different states, I just think Bally should get a lot more credit in its stock for that call option opportunity in the participation in sports betting and online casino going forward. It's also very good management team, experience in consolidating sectors. The chairman consolidated the broadcast sector before this endeavor.
You mentioned Sinclair, which is a TV owner. There's also a company that owns a lot of sports-related radio stations, which is Intercom, in your hometown of Philadelphia. Yeah. Do you have an opinion on Intercom?
Yeah, we actually do own the Intercom stock. We bought it well because it really got beaten up. Stock still is interesting to us. They have always had the sports stations and never really got much credit for it. But they're doing different deals with different companies to exploit their audience and to give them an opportunity to share in some of the opportunity in sports betting. I think it's still it's a well-run company. and exposed geographically with a lot of great stations that they bought the CBS Sports Network, radio sports network a few years ago. So definitely one that will be a player in this industry. Everybody wants to be a player in this industry because of the big opportunity.
You're on the board of Full House Resorts, as you have mentioned,
Yep.
and I've got two questions about Full House Resorts.
Sure.
One is Dan Lee as professorial in the boardroom as he is in other forums?
Dan is an encyclopedia of gaming. He knows everything about. He has so many stories. If you plan to be on the phone with him for 15 minutes, save an hour, because Dan will tell you plenty of great stories. And well before I was on the board, I've learned so much from him, and he's had a lot of successes in the past. A few things that he's missed, but very, very excited about him building this company up, and I don't see any reason why it can have some of the successes that El Dorado had as they grew as a company over the years, and is now this tremendous company and well respected with a great management team. I think that there's a possibility that they could be that in the next 5 to 10 years.
One of the things that I've noted very recently is now they have that they're financing for Cripple Creek expansion, and now they have legislation that makes creation of a transformational property feasible. I should think that's gotten investors given a lot more credibility to the story. And sitting out there is this sort of unique boutique VIP casino idea in Waukegan, where, you know, I just assume that the hometown boys at Rush Street have the advantage to get that license, but maybe Dan Lee and Full House get it. What would that mean for that company? One, what does Cripple Creek mean? And two, what would it mean if they did get Waukegan?
So both of them I would consider game changers for the company. It puts them at a whole another level, and getting the high yield offering done at a very attractive rate and well oversubscribed. That put them in a next level, I believe. The stock has moved up very nicely on that. But the Cripple Creek was a good project before everything lined up perfectly. The high yield market lined up perfectly. The loss limit went away in Colorado. The demographic in Colorado has continued to get better and better, particularly in that area, Colorado Springs. People are moving there like crazy, and there's a need for a nice property there, just like there was a need for a nice property in Blackhawk years ago when Ameristar built that property. We lose a lot of customers that are actually in Colorado Springs that go to Blackhawk. That's an hour further of a drive. It's tough to go up from anywhere from Colorado Springs up to Cripple Creek. And if you want to gamble late at night, it's a tough drive back, and there's almost no hotel rooms, and they're very low-end hotel rooms, 20-room hotels, very 3-star at best. Putting something nice there, people will stay overnight, they'll gamble longer, but also they'll get away. It will be a nice property with a spa and a pool, beautiful view of the mountains. Cripple Creek does not get its fair share of customers based on the adult demographic in the area. And we think that it will start to get its fair share, and the property will be very successful. Could add $30 to $50 million onto the EBITDA of Bronco Billy's at some point in Cripple Creek. Waukegan, we think we have a good opportunity there. Certainly very difficult competition, well-connected competition. That property, we could spend $200 to $300 million on it, maybe 250, and could have a very, very strong return into the 20% plus based on the demographic over there. So those are my thoughts, and not the company's, but I think it could be worth several dollars a share to the stock if they win that project.
Okay, well, we've covered a lot of ground. Eric, anything else you'd like to add?
We cover most of it. Again, really appreciate your time and the service that Vantini Research has provided over the years, and our friendship over the years. So thank you.
Eric, thanks very much. And I in turn appreciate yours. and we'll talk to you again soon, I hope.
Okay. Yep. Thank you.